Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to check in after the first half of the year and discuss some of the risks that we're watching for the remainder of 2024. So the second quarter produced significantly mixed results across various stock market segments. Ongoing enthusiasm for AI-driven tech companies powered the S&P 500 and the NASDAQ higher, but indices with less exposure to technology, such as the Dow Jones Industrial Average and the small cap Russell 2000 index, actually posted negative returns. We also saw a dose of volatility for the S&P 500 in the second quarter. Hotter than expected inflation reports in April, along with comments from New York Fed President John Williams on potential rate hikes, caused the 10-year Treasury yield to rise from around 4.33% at the beginning of April to a year-to-date high of 4.7% that month. And during that time, the S&P 500 fell just over 5% from the beginning of April through April 19th. Eventually, the Fed did dispel concerns around potential rate hikes, and that sparked a rebound rally that pushed the S&P 500 back to new highs. So as we get into the third quarter, stocks have been riding a wave of optimism. Since those higher than expected inflation reports in April, inflation hasn't appeared to be reaccelerating further. The Fed also appears ready to cut rates for the first time in over 4 years this September. And throughout most of this year, economic growth has remained relatively stable. Those factors, along with the strong earnings growth from those AI-linked tech companies, have supported the markets. But that's also pushed the S&P 500 to historically rich valuations, and we're always mindful that market dynamics can change very quickly. Volatility could be driven by a number of factors: slowing economic growth, an eventual rebound in inflation, underwhelming second quarter earnings, and of course, geopolitical surprises, including the upcoming US elections. And given the high levels of investor optimism and the current valuations in the market, we expect that any of those things could potentially spark another market correction. In the near term, though, economic growth slowing a little bit more than expected and or weakness in the artificial intelligence narrative could be the more substantial threats. Over the past 12 months, though, we have tilted portfolios to areas of the market where we believe valuations are a little bit more reasonable and may actually be poised to close the gap with some of those high-flying tech names if market volatility picks back up. So thank you for listening, and if you have any questions about your portfolios, please feel free to reach out to your SFMG team. Thank you.